Welcome back, everyone. In today's explainer, we're unpacking a concept that, well, it kind of sounds complex on paper, but it actually governs the economic reality of our daily lives. I want you to imagine an entire nation. Let's take Britain, for example. Don't think of it as a sprawling landmass with millions of people. Instead, think of it as a single giant entity with one massive central bank account. And just like you or I balancing our own checking accounts, this giant entity has to keep track of every single bit of currency flowing in and out of its borders over a given year. Okay, let's dive into this and crack open a country's master ledger.
It's a massive question, right? I mean, when millions of people, businesses, and government agencies are constantly buying and selling things all over the globe, how on earth does a massive economy track the sheer velocity of cross-border trade? How do they know exactly what's coming in and what's going out on such a colossal scale?
To solve this accounting history, we're going to follow a really simple four-part roadmap. First up, the macro picture. Second, money in versus money out. Third, the two main accounts. And finally, the ultimate balancing act.
All right, let's kick things off with Section 1, the macro picture. Before we even start calculating the inflows and outflows, we really need to understand why a government actually cares about this accounting exercise in the first place.
So, any government running an economy is basically juggling 7 main macroeconomic objectives. They're constantly striving for economic growth, keeping inflation stable, ensuring low unemployment, maintaining low inequality, protecting the environment, keeping a balanced government budget, and finally, our absolute star for today, maintaining a stable balance of payments. Keeping a stable financial balance with the rest of the world is absolutely vital. Think about it. If a country can't reliably pay for the stuff it consumes or secure revenue for the stuff it sells, it risks severe economic instability. We're talking catastrophic currency crises or literally crippling debt spirals.
And that brings us right to our formal definition. The balance of payments is essentially a massive ledger. It's a strict, comprehensive record of all the financial transactions made between consumers, businesses, and the government in one specific country and everyone else in the rest of the world. It totals up every single payment moving across the borders. Basically, if currency moves, it goes in this ledger. And we are talking about everything here, folks, from a multinational corporation executing billions in foreign direct investment all the way down to a tourist just buying a quick cup of coffee at an airport cafe. The whole shebang.
Moving right along to Section 2, money in versus money out. Now that we know what the ledger actually is, let's figure out the fundamental rules for how these global entries get recorded.
Every cross-border transaction relies on directionality. Simply put, there are economic activities that result in a country getting paid and activities where a country is doing the paying. We are constantly weighing the revenue generated from selling our exports against the capital that exits our economy to finance all those imported foreign goods.
So the absolute crucial point here is how we label these movements. When we export goods, the payment we receive is a money inflow, because foreign currency is entering the economy, which, by the way, often increases demand for our own domestic currency. It's seen as a positive contribution. Therefore, it gets recorded as a positive entry or a credit in the master ledger.
Conversely, when we import foreign goods, our domestic capital leaves the economy. This outflow of currency represents a claim by the rest of the world on our resources. Because that capital is literally flowing away from us to finance foreign industries, it has to be recorded as a strict negative entry or a debit.
Okay, into Section 3, the two main accounts. Because, as you can imagine, all of these credits and debits aren't just tossed into one chaotic pile. They are meticulously categorized into two distinct pockets. The first pocket is called the current account. This is the section of the balance of payments where payments for the purchase and sale of raw goods and services are recorded. When you think of the current account, I want you to think of the tangible imports and exports we see in the economy every single day. If citizens are buying physical cars manufactured abroad, yep, that goes here. But it also covers invisible services. Think about things like software subscriptions, international consulting, or cross-border banking fees. All of that trade in goods and services lives right here in the current account.
Which brings us to pocket number 2, the capital and financial account. While the current account handles the goods and services, the capital and financial account is where flows of savings, investments, and assets are recorded. This account is focused entirely on the underlying financial architecture. We're talking about the purchase of foreign stocks, cross-border real estate acquisitions, or governments buying up foreign bonds. It measures the real flows of actual money and capital moving from one jurisdiction to another.
Now, conceptually separating these two is absolutely key. To really grasp a country's macroeconomic position, you got to keep these domains distinct in your head. On one side, the current account tracks the tangible economy, raw goods and services.
On the other side, the capital and financial account tracks the financial plumbing, the savings, the investments, and the asset transfers. Two completely different pockets, measuring two vastly different types of economic activity.
And that brings us to our final section, the ultimate balancing act. This is where the magic happens, and we get to see how these two seemingly independent pockets intrinsically react to one another.
This is honestly one of the most fascinating rules in all of macroeconomics. Even though the current account and the capital and financial account are measuring entirely different things, raw physical goods versus financial assets, in the long run, they should always balance each other out. And no, this isn't just some lucky coincidence, it's a mathematical necessity dictated by double-entry bookkeeping. Every single transaction has two sides. Plus, in a system of floating exchange rates, the shifting value of a nation's currency naturally acts as a giant shock absorber, constantly adjusting the price of exports and imports to force this broader macroeconomic equilibrium.
Let's make this super concrete. Remember, the total balance of payments is just the combination of these two accounts. Let's say a country runs a massive trade deficit, meaning it's importing way more goods than it exports, so its current account is severely negative. Let's call it minus 100. Well, that gap has to be financed somehow, right? The country doesn't just get all those imported goods for free. That deficit is inherently balanced by a surplus in the capital and financial account, valued at positive 100. The shortfall in physical trade is made up for by an inflow of foreign investment or debt. So, when you combine those deficits and surpluses together, what do you get? They net out to exactly zero. Every single import is financed by a corresponding financial flow, meaning the global ledger inherently balances itself. Because of how the inflows and outflows of goods, services, and investments perfectly counterbalance each other across the globe, the final balance of payments, in the long run, always equalizes to a perfect zero. But that perfect zero leaves us with a massive real-world puzzle. If the final balance of a country's master ledger is essentially mathematically forced to equal zero, what does it actually mean for a country's long-term future if it constantly runs a negative current account? If a nation is perpetually buying way more physical goods than it produces, relying heavily on its capital and financial account to balance the math, well, it means it must constantly sell off its financial assets or take on deeper and deeper foreign debt just to survive. So the real question is, how long can an economy sustainably sell off its future to pay for its present? It's a fundamental question of global economics, and it's one that completely shapes the geopolitical power dynamics we see today. Something to think about. Thanks so much for joining this explainer, and we'll see you next time.